And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is David Blatt, CEO of Capstack Partners with approximately 100 million in assets under management. David, thank you so much for coming on the show.
Thank you for having me.
So, David, I always like to begin. Can you tell us a brief story or your story on how you got involved in this business?
Sure. So I had just graduated from business school, and I was actually working in the first wave of the dot-com bubble for a bit, just making really great money out of school, but not fully understanding why. And then it burst shortly thereafter, and so I was trying to figure out, where I could really start to create value, create wealth, and I was really attracted to investing in real estate assets for quite some time, and so that was when I decided to make my move. And I started my first job working for a small investment firm that was primarily focused in distressed real estate investments. They were buying non-performing notes primarily. They had a specialty in environmentally impacted real estate, and so that was their background. And so I was working for them. I actually started at that firm in the receptionist position by choice, mainly because I looked at it very much like an apprenticeship. And in fact, I approached the owners at the time and said, I'm going to take this job. You're going to have the most overqualified receptionist, but I want to learn everything about the business. I want to be able to earn equity in the investments that get made while I'm here. And also the caveat is, once I feel like I've got it down, I'm leaving to start my own firm. So a couple of years later, that's exactly what happened. I did leave. I did start my own investment firm. I started to invest into discrete real estate investments that were impacted in some way or undervalued and distressed, and then started to scale that up and was able to attract a private equity fund to the business right at 2008, when the market started to really seize up. And a lot of funds at the time, particularly focused in the real estate space, had raised capital, but now were looking to pivot into distress and just had no infrastructure. So it was just a great time to go out and raise capital, which I did. I structured an investment with this particular private equity fund and was able to have a really strong run of investments through the downturn up until about 2012, when the market started to rebound and everything in the distress space really got bought up by a lot of the larger institutions. And so I dissolved the fund. I formed Capstack Partners shortly after that, and I decided to just really focus on making discrete investments, working on the advisory side with lenders, and also structured as an investment advisor with high net worth family office capital to make more one-off discrete investments, simply because there hadn't been enough of a pipeline to really support distressed opportunities over the last number of years. And that's really where I've built up the business to date. And as you mentioned, there's about 100 million in AUM, which has been built up through that execution. And now, certainly where we are in the market, I'm pretty excited about opportunities in the distress space. I certainly think that we're going to see much more of those towards the end of the year and certainly into next year. But we can get into that.
Yeah, no, that makes perfect sense. So before the call, we were chatting, and I'd asked you a word that I just heard you say. So can you explain to us the difference? And you just said it again, so it triggered my memory. Can you just explain to the audience the difference between distressed assets and discrete assets? It was discrete, the other word, by the way. Yeah.
Got it.
Yeah.
So, so the distressed assets are assets that have been negatively impacted by some circumstances. about a default of some kind, either a non-performance by virtue of payment default or performance default, or sub-performing, which is another category of that where, you might have a borrower who's falling behind on payments or, not performing according to the terms of the loan. Discrete investments aren't really correlated. What I mean by that is usually in a fund model, you get an allocation of capital that needs to be deployed. Your performance is measured within the scope of that fund. And so each investment, you could have an investment, a discrete investment, meaning a one-off that can do really well and one that might not do as well. But in the end, you're really going to be measured on a performance basis against the overall fund's performance. Whereas when you are raising capital for discrete investments, I mean that in the context of, call it one-off deals that I'm able to source through lender relationships that I've either maintained or identified, or distressed sellers of various profiles, and then accessing capital for that particular deal. And then the performance of that deal is really measured and stands on its own versus as a blend, like in the context of the fund.
No, that makes perfect sense. Thank you for that explanation. So before I ask you my next question, I do want to touch a little about your story and how you began and dive a little deeper there. I know that you have a tremendous amount of education behind you, more so than the average quote unquote money manager or investor. Can you explain a little bit about how you gotten some of your background from an educational standpoint, academia, and also why you went that direction and ultimately what led you into investing in / real estate? Because I know you have a JD.
Sure.
And, yeah, go ahead.
Yeah, so I have a law degree. I have a master's in negotiation and dispute resolution, and I have an MBA. I started in law school, and immediately when I started in law school and I was interning at law firms, I concluded that whenever I was working on transactions, particularly in internships, I wanted to be the guy doing the deal, not the lawyer doing the paperwork for the guy doing the deal.
Right. I love that, by the way. That's excellent.
So once I came to that conclusion, I actually fast-tracked my law school education. So it's traditionally 3 years. I took summers so that I could get it done in 2. And I started taking more practical classes there, and a lot of them had to do with negotiation and dispute resolution. And so that's really what led me to the master's program. So that was, I just felt like that was giving me a good grounding for purposes of deal making. And then, of course, the MBA was just something I always loved business. And so I had an undergrad business degree, so it really just came full circle. And frankly speaking, by virtue of having fast-tracked my law degree and the master's, I was able to actually get all 3 done in a span of 4 years after college. So the other reason that I was really pushing to get all of that was, aside from recognizing that I wanted to be focused on deals and deal management and investments, I also realized early on that the path I wanted to take getting there was not going to be your traditional go work for a big bank, build your pedigree off of the brand of that large institution, and then leave to form your own shop or, some kind of variation on that theme, which a lot of people do and certainly do successfully if they don't stay. And so for me, I knew that I was going to be blazing a much more entrepreneurial path to achieve that. And so I felt that, especially early on in my career, as I mentioned, I went and I worked in a receptionist position right out of the gate, just really to get, it was more of an apprenticeship for me. But knowing I was going to start my own firm, I just felt like having that education, aside from the fundamental grounding and foundation of just being able to analyze and understand things also gave me a level of credibility that I was able to utilize because I didn't necessarily have those like big bank marquee names behind me in terms of just, serving my time in those places, but still demonstrating that I could bring value to the table, at least from a marketing standpoint, if you will.
No, I love that. And I have a lot of parallels with that story as well. Number one, I never worked at a big bank either. I've charted my own course, so to speak. I started my business in my dorm room in grad school, which I fast tracked undergrad 3 years instead of 4, and then grad school in 18 months instead of 2. So yeah, I can relate. I didn't go down the JD route, even though I should have in hindsight, but I did political science, both undergrad and grad school. So I was definitely in that JD, route or path. But I got bit by the investment bug and decided to go into Wall Street and start my own shop. And here we are 20 years later. Okay, so thanks. So a few questions for you. This is about negotiation and just more of the negotiation side. The dispute resolution also piques my interest, but from the negotiation side, I love it. It's fascinating for me. And you're doing deals with real estate and other investors, or buying stocks or futures or commodities. It doesn't matter. There's a negotiation taking place. And I'm fascinated by psychology. I love to know what makes people tick. I love the art of negotiating, of doing deals, so on and so forth. Can you speak a little bit about what you learned from an academic standpoint with respect to negotiating and structuring good deals, but more importantly, the practical aspect of it, what you use on a day-to-day basis to help you negotiate and then / invest? Because I know a lot of investors, they look at the market, they look at whatever their underlying investment is, but they don't really understand or spend a lot of time on that negotiation side, whether it's negotiating with themselves or negotiating with the market or whatever the case may be. So if you can shed some light on that subject, I'd be very interested, please.
I think that it is an area of investing that is, I want to say, underrated and not thought about as much as things like data and strategy tied to numbers and performance in that context. And I think it's a huge factor. The human factor, it fascinated me always, and after all these years of really just applying a lot of what I would describe as training, but is now more second nature, because you're really just taking a human psychology element and not injecting it, but recognizing it into the investment side of what you're doing. And it really, really weighs in. I've seen it materialize in deals where, you just look at things and objectively, what the right decisions are, both for yourself, both for the counterparty with whom you're working. And yet, you'll see people, be driven by something entirely different than the best course of action for the investment or value, or, all those really rational, objective things that, we read about and think about, and, we're supposed to discipline ourselves to adhere to when it comes to investing. And, I've seen people sabotage themselves in deals, just because they've just taken a hard line. And so it's something that any good investor really needs to pay attention to throughout a process of execution at a deal level, and really just manage so that, you could be right and you can have everything supporting you. And yet, if you don't consider that, how that's going to get you from point A to point B successfully, it can go wrong. And I've seen it go wrong so many times if it's just neglected and not managed. So I really just think about that factor, and it doesn't fit into any spreadsheet, and any projections and any, market studies and any of that. But it's really of such import when you're forming your investment strategy and then implementing that.
Yeah, David, I have I mean, echoes my entire. This is the first time we're speaking, literally the first time, but the parallels are uncanny. I have a book coming out called Psychological Analysis, which is just on that exact topic, where I argue the whole premise of one of the premises of the book is to help people make better decisions. They have to learn how to make objective, not emotional decisions with their money. So it can go deeper and deeper and deeper, but high level, that's kind of where my head's at. And what I've learned along the way, and like I mean, everything you're saying resonates so powerful. So I'm just curious, how do you recommend people do that to get out of their own way, so to speak? Are there any practical things you've learned in your journey that you can share?
Yeah, absolutely. So, first of all, I think that you're touching on a good point, right? So when you really break it down, you know, you're negotiating always, right? And so that negotiation certainly starts internally with yourself. So I think it's important when you're analyzing, an investment or a particular investment strategy, it's really trying to fully understand the why behind that and what that driver is, and really itemizing, if you will, what this investment represents for you that isn't necessarily quantitative, or if it is, what that quantitative result achieves on a qualitative level. So this way, it's almost like a gut check from that standpoint, and then being able to manage drivers because, at some point, it's about the things you can and can't control, right? And you'll have reactions to the things that you can't control. And it's also recognizing what those drivers are. So, that to me is always a stage one of analysis related to that. And then the second component is really identifying the stakeholders involved in a particular investment or deal on which you're working, and really trying to understand what their drivers are, because it's it. I think that that's a crucial element of getting to the successful finish line, and a lot of times it's more than what they might be articulating and representing to you, right? People take positions in negotiations all the time, but it's that underlying driver that you really want to think about, or try to find out, because that's the thing that can either fast track and get you to where you want to get to in the best form, or become a huge impediment just simply because you didn't anticipate what that might be. And again, it may not work for that other person's interest, right?
Right.
So, to some degree, it's like, okay, I have to anticipate what these other people want. They should know what they want.
Yep.
I mean, should is should, but we're talking about how we're going to be successful on execution. So this is part of successfully implementing an investment strategy. And so those are the two things that I do spend a lot of time when I'm initiating a particular, if I'm pursuing something, or following through on an investment or an investment strategy. I'm always thinking about the different stakeholders, what their drivers are. Am I addressing those? Can I address those? How important is it to address those? And really but at least factoring those in and acknowledging those so that I don't run into any hurdles that have nothing to do with numbers and performance or anything of that sort.
Right. The quantitative side of the numbers and the qualitative is the feeling or the taste of it, so to speak.
Yes.
Yeah, that makes perfect sense. So, okay, I guess my next question for you, David, is, well, I guess, how do you handle risk? And what are some mistakes you see people make with respect to risk management?
Uh, so, with respect to the first part, I focus on distress, right? So, people have a sense that there's inherent risk built into that kind of a strategy. But I've always looked at it, you know, distressed investors are actually the most optimistic of investors. We believe that there is increased value in the future. We're just buying it at a basis that reflects dislocation because of some circumstance or story at the asset level, or at the secular level, or something along those lines. So, but more specifically, I look at it, in three ways. First of all, I always approach deals as making my money on the buy. So I look at it from a basis standpoint. If I'm in low enough that I don't have to necessarily anticipate everything, and it's a very simplistic approach, I realize, but I certainly I have all the financial models. I do all the due diligence. I'm pretty meticulous, but at the same time, I just like the idea that if I was just the dumbest person in the world, if I buy right, I'm still going to find a way to A, preserve my initial investment, and B, make some kind of money. That's already a good start.
So for you, just to make sure,
second,
sorry, let me just make sure I understand.
yeah.
So that from a risk standpoint, you're saying the whole key for you to mitigate some of that initial risk is to make sure you're buying super low, buying right.
That's right.
Okay.
I always just my philosophy is like make your money on the buy.
Right.
You're just like the second you bought, that you've created like an asymmetric bet, right?
Mhm.
You're just like so low on the downside, and you've really got upside that can materialize through market movement, and hopefully by you just taking more active management roles with respect to the value creation.
Right.
So that's the first aspect of it. The second facet is by virtue of that, and as an extension, I like the optionality of exit. When you're buying at a certain basis, you're in certain cases, if you're buying something that's fully valued, you're really limited in where you can go and what you can do from a value creation standpoint. You're either subject to the market continuing to buy into the appreciation of what you've bought, or you're doing incremental things to maybe enhance value, but your hands are somewhat tied, and the execution is typically one avenue or possibly two. Whereas if you're buying low enough, you can kind of pivot a number of different ways to create value, and some obviously are going to be paths to greater value than others. But again, you could at least stay flexible and resilient in trying to create value. So I like the optionality of exit as a means to risk management, as a second component of how I'm looking at things and how I approach them.
Gotcha. So that makes perfect sense. Go ahead. Sorry.
and then finally, my third aspect of it is really, to the extent that I can, approaching things with a longer time horizon to exit. And I think that's frankly one of the advantages of assets in the alternative space, like real estate, real assets, versus, let's say, public market strategies, where I can buy things with an exit horizon of years, and that gives me some latitude in just really handling a lot of the near-term gyrations of what the market may be doing, what the economy may be doing, and so that just helps a lot if I can have it. Sometimes you're just in an execution that is just a much quicker fuse, and it is what it is. But nonetheless, if I can have that element in there, I think that's a real aspect to manage risk. That it's just so beneficial. You're not subject to anything that happens near term. And it's like you see all these a lot of these market cycle graph lines. When you zoom out, it's like that really smooth line going in a particular direction.
Right.
But
right.
You look at the daily movements, and it's like up and down.
Yep.
If I can get as close to that smooth line as possible at an investment level, it's just much more effective to really just work through the investment and the investment strategy that I have for that particular deal, without necessarily getting sucked into the near-term movements that might be impacting it at any given moment.
Gotcha. Makes perfect sense. So what is your, I know you're in real estate, it's a little bit different than, well, in many respects different than listed publicly traded markets like stocks or commodities or futures. But what is your average holding period or time frame for these distressed assets that you're buying?
So they're actually a lot shorter, right? So traditional real estate, is a very very long run buy and hold. It could be 5 years, 10 years. With distressed assets, I mean those things typically our holds have been anywhere from, let's say, like 6 to 24 months. In real estate years is like a very short hold period, because you're dealing with such a huge fixed asset at a deal level or even at a portfolio level. So it's not a particularly long hold. We're just stepping in and taking advantage of whatever the negative impact to the asset might be, and looking to create value actively to a point where we sell it and can achieve a acceptable return or better.
No, that makes perfect sense. So, what are some timeless lessons, David, you've learned along the way that you'd like to share with the audience?
So I think that there's a few, but I'll probably just distill it down to a couple. You know, I think that staying resilient is a key aspect of how I have approached my investing over the last 20 years.
And what does that mean, staying resilient? Can you explain that, please?
Yeah, absolutely. So, first of all, it's about being able to pivot when it makes sense to. So I've always been a distressed investor. Okay. However, there really hasn't been a volume of distressed opportunities for many years, simply because the market's been so strong. And so for me to sustain my investment strategy, I really had to think about how to essentially change my platform to support my investments, as well as to just support any investment platform. To be able to have, what I would describe as a blank check institutional capital relationship into a major fund vehicle, and manage, like at its peak through the 08-09 recession of 250 million, and then say, you know what, in 2012, I got to shut this whole thing down, because if I keep taking this money, I'm going to start dragging on my return, and I'm never actually going to see anything out of this. I mean, that's a very difficult thing to do for some people.
Right.
But that's the reality of things. And so I recognized that fairly quickly. And I said the best way for me to sustain the ability to continue investing was to completely dismantle the platform that I built over a decade and reform it into something entirely different that probably wasn't going to see the volume of deal flow, because that's where the market is, and then just keep going in that direction. And I think that takes a lot of discipline. And again, just so I'm pointing to that as a very real example of what resilience can be,
right,
at a very high level.
Right.
People can get caught up in the fact where they start to project themselves as, I'm this fund manager who manages this amount of money and deals with this kind of capital profile. I'm going to continue down this path, because if I don't, then I have failed. But in effect, continuing down that path will result in actual failure.
Right. No, understood.
So,
understood 100%. Understood.
So that's really being responsive to whatever you want to call it, the market environment, or just the reality of a certain situation. Even if you want to take it down to a micro level of a particular investment, it's like when you have to make those tough decisions about whether you exit out of something, that might have underperformed or, actually generated a loss, but, continuing with it could make the situation worse. So, that's the lesson with respect to staying resilient and really just being responsive to, wherever you're getting information. But when it comes in, being able to process it and react accordingly and responsibly, both for yourself and for your investors, I think that that's a huge, huge positive aspect of being able to sustain success for the long term.
Yeah, no, it makes perfect sense. So on the other side of that, what are some timeless mistakes you see people make, and how do you recommend they avoid them?
Uh, so I think that one of the key things that I've learned over time, uh, that I think a lot of people don't do early on. I've certainly made that mistake, but is having enough uh, in reserves to sustain either maybe some near-term losses, or even just having reserves when you have a drought in deal flow. Sometimes investments just don't present themselves, and you just got to, maintain, be patient, wait for the right opportunities. I mean, continue to pursue things, of course, but at the same time, everybody has a burn rate. And I think that the biggest mistakes I've seen is when people start to reach for opportunities just because of that need to be able to execute and deploy capital. And you start to make mistakes where people get hasty. The due diligence and underwriting starts to get a bit sloppy. The reach in pricing gets too high, and you're now taking higher risk positions that end up getting, backfilled from a thesis standpoint to justify that. Usually market momentum is the reasoning behind that. And so I think that the solution to that and how to avoid that is really just, it's super, super important to have that capital reserve, at many levels, personal, professional, at the investment level, at the platform level, to be able to really maintain, whatever it is that you're subscribing to as an investment philosophy and a strategy, and not compromising that, which could end up resulting in making huge mistakes that result in investment losses.
Gotcha. No, that makes perfect sense. So I guess what's the best piece of advice you'd like to share with the audience for, in life or in markets?
I think that the best piece of advice is, the one thing that I've learned is that, experience is hugely valuable. I think that, touching on how I started in my career, how you mentioned you started in your career, I think there's really no substitute for that. And I think that being entrepreneurial in the investment space is, there is no direct path by definition. But I think that a lot of people also count themselves out simply because they think that they don't have the right background or pedigree, whether it be by education or by, where they might have worked in order to get into the business, so to speak. But I actually would say that anyone that has an interest in investment management can simply start by just accessing information and really just getting into it. It's absolutely something that someone with an entrepreneurial mindset can be very successful at, even if they don't necessarily come from the right background, whatever that might be.
No, that makes perfect sense. So, David, I want to thank you very much for coming on the show today. The final question before we end it is for most investors, and this is more for individual investors, but also for institutional investors. We have a large audience of both on the show. They are interested in getting in real estate. What advice do you have for them with respect to finding distressed assets? Do they look for properties that are just, beaten up or left for dead, so to speak, or do you recommend going for like residential, commercial, or where would you recommend people focus, especially in this, post-COVID or COVID, not really post, but COVID world / post-COVID world as we move forward?
So I think that you know no one no one's out there saying, "Hey, I've got a whole bunch of properties that are bleeding," or if you're buying the debt on those properties, will you have lenders that are necessarily marketing them in the same way that you might access just a traditional marketed deal? The way that so first off, in terms of types of opportunities, I think that there are a tremendous amount of opportunities across every asset class in the commercial space. I mean, certainly hotel and retail assets specifically have gotten hugely beat up under the current circumstances. Now, I just want to add, there's definitely two aspects to it. One, I think there's a baby with the bathwater
Right.
discounting that's happened, right?
Right.
Everything cannot be bad.
Right.
So the follow up to that really comes down to, what kind of time horizon your money has. Because if you I don't think, let's say, just from an investment thesis standpoint, that the concept of hotels goes away.
Right.
Right. It's really more a function of when does it come back. And so if you're going to invest in that kind of an asset, I think there are opportunities right now, huge ones, to be able to get a hold of at discounts. But you might have to hold for some time on those.
Right.
And in terms of access, it's really it's nothing more. You're not gonna. It's not brokered. You really need to go and have either direct conversations with owners or with lenders about what they have that they want to divest at the moment, or just being patient a couple of quarters to be able to have that conversation. The good news from a distress standpoint is that institutions and lenders right now, they're getting a free pass on 2020. And by that, I mean, they're sufficiently capitalized that they're healthy. And so if they let go of assets and take a haircut on loans that they have on particular real estate that's non-performing,
right,
nobody's going to ding them on share price or value, because everybody we've all, to some degree, said, okay, 2020 is a pass for you guys.
It's a wash.
We get it.
Right.
Yeah. So, by year end, my expectation is that you're going to see lenders, say, all right, you know what? I gave these guys forbearance. They're just not coming back around. I just got to cut loose and just, take what I can get and re-lend it out into healthier assets and recoup that way. And so, I think that approaching, whether it be local lenders or by asset class, to that end, investors should really think about, what they're going after, and then having those conversations directly. You're not going to see brokers moving a lot of this stuff because it's just not that kind of a market.
Right. No, that makes perfect sense. So, David, you've said a lot. You've shared a lot with the audience. You've done it all. Thank you so much for coming on the show. This is David Blatt, CEO of Capstack Partners. What's the best way for people to get in touch with you if they want to follow up and speak with you directly?
I would say hit me up on my LinkedIn. I'm fairly active and responsive there.
Okay.
And otherwise, my website's capstackpartners.com. So you can certainly go that way. But if there's any questions or anything of that nature, I try to be as responsive as possible. And LinkedIn's always been the best medium for me to engage.
Perfect. Well, thank you so much, David, for coming on the show today. It's been an absolute delight.
Thank you for having me.